Yeah. Okay, good morning. It is with great pleasure that we welcome you to ABDF or ABDF webinar. Today, we have the distinct honor of hosting two distinguished speakers from the IBFD who will enlighten us on the crucial topic of unilateral measures in international taxation. We extend a warm welcome to Vanessa and Diana, sorry, whose expertise and insights in the field are invaluable. Their presence adds a significant dimension to our understanding of the complexities surrounding international taxation, and we are eager to delve into the depth of their research. The importance of unilateral measures in shaping the landscape of international taxation cannot be overstated. As we navigate through the intricacies of the subject, we are certain that the knowledge shared by our esteemed speakers will prove to be both enlightened and thought-provoking. Anna, please.
Now I will have the joy of presenting our speakers, and I will also present my friend Felipe. Thank you so much for all of you for being here. It's such an honor, and I'm really eager to learn with you. Well, since most of our audience is Portuguese speaking, if you do allow me, I will read your CVs in Portuguese. Then I will switch back to English afterwards. Yeah. So we have the joy and the honor of having with us Vanessa Arruda Ferreira. A Vanessa, ela tem mestrado em Direito Tributário pela Universidade de Paris, Sorbonne, a França, e ela tem um doutorado em Direito Tributário Internacional pela Universidade de Amsterdã, na Holanda. Muito obrigada, Vanessa. Diana Calderón Manrique, eu pronunciei corretamente, Diana? Mais ou menos, Manrique? Depois você me corrige, hein? Ela é editora-chefe do BEPS Country Monitor e do Digital Taxation Monitor. Ela também tem um LLM em Direito Tributário Internacional por Leiden. Somos as duas, então, pregressas de Leiden, que alegria. E eu também tenho aqui meu amigo, Felipe Renault, ele é professor visitante de Direito Tributário da FGV, diretor da nossa querida ABDF, que é a IFA Brasil, sócio fundador do Renault Advogados, e ele tem um doutorado em Direito pela Universidade do Estado do Rio de Janeiro, e atualmente é pesquisador num pós-doutorado pela Universidade de São Paulo, a USP. E eu sou Ana Carolina Monguilô, diretora da ABDF, and it's such a joy to be here with you. I hope that this will be the first of many other webinars and events that we will promote together. Thank you so much. And Vanessa, the floor is yours.
Thank you so much, Anna. Thank you, Felipe. And thanks for organizing this. Also, thanks to ABDF and Win Brazil for inviting us. It's always good pleasure to do things together. And yeah, it's always special for me also when I do something with Brazil, even though we're doing in English. But I think, well, we are blaming Diana for that, but I've been secretly liking the idea of doing that in English because it's also easier for me, at least for certain topics. Yeah, the first time I talked with Felipe about this webinar that we were discussing which topic could we do, I proposed on digital economy, taxation of digital economy, and he was a bit concerned in the beginning because Pillar 1 is really not seems to be happening. And I said, exactly. And that's exactly for this reason that we would like to talk about the taxation of digital economy, because we're not going to talk about Pillar 1 here. We're going to mention, of course, we're going to talk a little bit about Pillar 1 because it's important to understand the context. But our focus here is exactly on, I'm going to share already my presentation. Do you see that? Okay, so our focus, as I was saying, is exactly on what countries have been doing as an alternative to Pillar 1, so the so-called unilateral measures. And the more the time passes, the less credibility Pillar 1 seems to have, and the more support some unilateral measures receive from different voices, from academics and to government. And we're going to be explaining this a little bit better during the presentations, but maybe most of you know that as from 1st January 2024, so in a bit more than a month, many countries will be free to implement new unilateral measures. So the current suspension of new unilateral measures will probably be ending by the end of December. So we will probably see more measures coming. And that's why Diana and I thought, okay, that's a good moment to maybe discuss also on this topic. We have been talking and giving a lot of energy and time to understanding Pillar 1. So maybe now it's time also to consider other alternatives. And this is not that easy because it's not only a topic that involves legal aspects, but also political aspects. And we are also trying to solve it while we are already in the problem, because we are already having unilateral measures and they are multiplying. And I liked what I've heard not long ago in a presentation at the University of Amsterdam, something that was said by Leonardo Pignatari, that probably is maybe here also listening to us. And I've watched his presentation. He's the author of a very good book on Article 2 of the OECD model and digital service taxes. And he said something nice. He said, we are trying to fix the car while it's running. Or the boat, I don't remember exactly, but I think it was the car, which is the situation now. We are trying to coordinate and solve these while we have all the unilateral measures already there. So maybe it's time to really put the topic for discussion. And the longer it takes, the more difficult it gets, because the measures are multiplying. And I think that now, at least, well, hopefully we are seeing more, a growing number of arguments and ideas appearing that are not related to Pillar 1. And maybe it shows that we are kind of starting to refocus the debate, so to other alternatives. And webinars like these also help us in going into that direction. So we've been talking a lot about Pillar 1 for like years now, and maybe it's good to start considering other more practical solutions as well. So I'm gonna start. Yes. So when we were thinking about how to start these, I was discussing with Diana, and we were wondering if it would be necessary to explain all the underlying issue of digital economy and taxing the digital economy. Because probably you know it already, but I think it's always good to keep reminding ourselves of the real issue here that justifies all the discussions. And because if we don't have the real problem at the back of our minds all the time, we may end up falling into some argumentations that, in my opinion, they are more rhetorical arguments regarding unilateral measures, such as I'm going to read, that they are unreasonable measures, that they are discriminatory against the U.S. companies, that they are restrictive to the U.S. commerce, and that they are against prevailing principles of international taxations. And I'm reading this to you because these were the findings of the U.S. Trade Representative Office when they were investigating some digital service taxes that were applied in some countries. And these are also the arguments that they use to justify some additional tariffs and the trade war that they started. And we're going to talk about it later. So that's very important to understand the core issue of the problem. And what is the problem with the digitalization of the economy? It's because the digitalization of the economy allows some companies, when they are dealing with their cross-border transactions, to not pay the taxes that they used to pay to the market jurisdictions. So we are not talking about here of trying to tax a lot the tech companies, the big tech companies, because they're making a lot of money. That's not the point. They are making a lot of money, it's true, but the real point is that they are no longer paying the taxes that they used to pay in the first place in the market jurisdiction, because the tax rules that we have now no longer allow the outcome, the agreed outcome that we have for taxing business profits. And it doesn't appear anymore because of the digitalization of the economy. And what is this outcome, this agreed outcome? Is the sharing of taxing rights between resident and source states when it comes to business profits. And that we see in tax treaties, for example, but we also see in domestic legislation. And this sharing is basically that the resident state can tax, but that the source state, which is the market jurisdictions, they are also allowed to tax when you have a certain level of business being done in that jurisdiction. And back then, it was decided that this would be the case when you have a permanent establishment in that jurisdiction, the PE. The problem is that the PE threshold of the PE is based on physical presence. Because back then it was maybe decided that this is a good indication that there is some level of business being done in the market jurisdiction. But now that we don't need anymore this physical presence, or you need very little physical presence that normally would not amount to a PE, what happens is that you have a different outcome, which is you are having a certain level of business still in the market jurisdiction, sometimes a lot of business, but you are no longer paying taxes there because you don't have a PE, because the PE threshold is no longer appropriate to a digitalized world that we are in. So, so it's good to have in mind that it's not about taxing more the digital companies. It's just that they are no longer paying the taxes that they used to. So we need to readjust the rules so that they can come back to the same position and start paying again taxes in market jurisdictions. So it's good to, for example, when there is the argumentation of the US that this is against the prevailing principles of international taxes, it is not, because the prevailing principle of international is not the PE itself, it's the sharing of taxing rights between resident and source state. And the source state is entitled to have when you have certain level of business being done in source state. So the PE is just a mechanism to allow that outcome, but this mechanism no longer works now. So we need to rethink and adjust the threshold in order to allow the outcome that is the fair outcome, that is the agreed outcome, to happen again. So the efforts of adjusting the rules, they started before, for example, even we had the service fee that was already an indication of some countries trying to find a PE somehow, and they were basically considering, okay, you are not here, but you're using your website is hosted in the server PE here. So maybe under certain circumstances, we can recognize a PE there because you have a fixed place there of business at your disposal that you do business. And in some cases, you could even recognize a server PE, but you wouldn't be able to allocate or to attribute income or a lot of income to that PE because there's not much going there in terms of function, assets, and risk. So even though you could still try to find a PE, you wouldn't be able to allocate or attribute income to that PE. So the market jurisdictions are the big losers here because they're no longer able to tax non-resident companies that do business there but are not present physically. So what happened is that countries started to try to solve these unilaterally initially. So they were trying to find ways to tax back these non-residents, and they started to implement some unilateral measures, and we're going to talk about the unilateral measures soon, because there was no one took the lead of solving the problem. So these started already in a non-coordinated way between countries until the moment where the OECD, under the BEPS project Action 1, on addressing the tax challenges of the digitalized economy, recognized the problem and agreed that the rules no longer serve the purpose and we need to change the rules. But they didn't come with a solution. They just recognized the problem. They recognized that countries were solving it unilaterally, but they thought we need a global solution. But they didn't have one back then. They followed up, of course, later on with BEPS 2.0, Pillar 1, and Diana will later talk about that. So the big thing here now is we need to think outside the box, and we need a new nexus, because the physical presence can no longer be the nexus to allow the outcome of market jurisdiction taxing non-resident companies when they have a certain level of business being done in that jurisdiction. The BEPS Section 1, actually, as I said to you, did not come with a conclusion on that, at least for the direct taxation, because we are talking here about direct taxation of business profits. So you can no longer tax the PE because you don't have a physical presence. But the BEPS Section 1 report addressed also other issues concerning taxation by VAT, for example, indirect taxation. This is not the focus of our webinar because we're going to be talking about taxation of business profits and the direct taxation of business profit. But it's interesting also to see a little bit what happened in the VAT side, because you can learn and you can take the experience, especially in the collection methods of VAT, to also maybe apply for direct taxation. And what happened with the VAT is that in the BEPS report, BEPS Action 1 report, differently from the direct taxation part where they didn't come with any solution, they just recognized the problem. For VAT, they said the solution, which was not new at the time, it was just a confirmation, is the application of the principle of destination. So we're going to charge VAT in the state where the consumer is located. And the real issue for VAT was the collection mechanism for VAT, especially in B2C transactions. So when you are with a final private consumer. And in this case, the OECD said for B2B, we don't have much problem because we apply the reverse charge mechanism where the importer assesses and pays the taxes. And this is not really an issue. Countries do that normally. But for B2C, we have an issue because you cannot make the individual, for example, liable and responsible for paying the taxes. And so this was the issue of VAT. And back then in the report, the OECD said the solution for this is the registration, the simplified registration of the non-resident. So the non-resident providing services or selling goods, online goods, they would have to register in the market jurisdiction and assess and pay the tax. And for that, the OECD always used European countries as an example of how this is successful, because within the European Union, you have already that working very well. You have the non-residents having to register and pay the taxes. The difference is that under the European Union, you can enforce that. If you are a German company selling goods in Italy, you are under the European Union rules and directives. So you can ask and enforce that. You can make the non-resident, European non-resident register and collect taxes. The problem when we go to the world is that you cannot force another company to just register and pay. You have to hope that the company would do that. So the solution by the registration as a non-resident that was advocated by the OECD was not as successful as they thought it would be for other countries. And countries were complaining, how can we enforce that? And the answer of the OECD was, you just have to make it simple. If you make a simplified system for registration, they will come and they will register. The EU did that because they have since 2021 the one-stop shop or one-shop stop, where you don't have to register in all countries that you have business with. You just have to register in one country within the European Union, and that would satisfy that. But for the other states outside Europe, they were having problems in even offering this simplified registration. They were not seeing that as successful as they thought. So they started to apply other measures to try to collect taxes from B2C, and which was basically involving intermediaries for that collection, platforms, banks, financial institutions, credit card administrators that would be responsible for collecting the VAT in B2C transactions. And until the moment where the OECD started to recognize that, and you can see, for example, there were many reports issued by the OECD on that, but only in 2019 is that the OECD issued a report on the role of digital platforms in the collection of VAT on online sales, where the OECD said, okay, I've been receiving many requests from many countries to start addressing other forms of collection, and they decided to bring the solution of making digital platforms involved in this collection mechanism. They didn't really advocate. They still said the best solution is the registration by the non-resident, but it may be helpful to also involve digital platforms. The digital platforms can be involved in different ways. They can be liable, completely liable to collect the VAT. They can be responsible as a joint liability with the supplier, and they just collect on behalf of the supplier, or they can not be involved at all in the collection, but they can be subject to some reporting obligations. So they disclose information regarding the transaction, the nature, the who is the supplier, the amount, and other type of information, so that they can use the information to collect the VAT from the underlying supplier. So that was what the OECD did. There were still other methods of collections that were used in Latin America by using financial intermediary like banks and credit card administrators that the OECD did not really recommend. They actually, if you take, there is the toolkits, like the OECD issues some toolkits for different regions, and there is one for Latin America. And if you check that, they recognize that some Latin American countries were doing that. They were using banks, financial institutions, credit card administrators to collect the tax. But they don't recommend that because they say that they don't have enough information to collect the VAT in a proper way, because they don't know exactly sometimes the nature of the supply, which rate to apply, or if there's an exemption or not. So they would end up making wrong collections that would later on result in extra burden of like giving refunds back and some compliance costs. They would also say that taxes may also be evaded because of the form of payments that the private consumer could choose outside the traditional banking system. So they could pay with vouchers, and they could pay with e-wallet or even cryptocurrencies. So, and these would fall outside and they would not pay the taxes. So they didn't recommend that. So they still recommend the registration of the non-resident here, and maybe also the use of digital platforms at a certain level to also help with the collection. So all these is not really the point of the unilateral measures on direct taxation, but they are interesting because they can also be used for some unilateral measures as also solutions for the collection in B2C transactions. I think Diana now.
Yeah, thank you so much, Vanessa. And well, thank you, IFA Brazil, for the invitation. It's a pleasure to be here. Now, what I'm going to talk, we're not going to spend much time here. I just want to give an overview of what has been done in the part of direct taxation and just set the scene a bit for everyone to know what has happened there. What has been done both from the OECD perspective and from countries unilaterally to tax the digitalized economy. So I'm going to go back and start in 2015 with the BEPS Action 1 final report. As Vanessa mentioned, this report didn't have any recommendations and they didn't reach consensus. It's the only action that doesn't have specific recommendations. However, it's very relevant for us because it addresses the tax challenges of the digital economy. They recognize that with the new business models that happened due to the digitalization of the economy, there were new issues coming up for taxation. As Vanessa said, the issue of the nexus, the issue of the data collection, the issue of income characterization. And for this, the OECD in the report said that countries were already taking measures. So they identify possible measures like significant economic presence. They also identify withholding tax on digital transactions and equalization levy as possible measures that countries were taking to tackle these new challenges. It is important that at this point in time, so 2015, the OECD said that countries are allowed to implement these measures always if they comply with the treaty obligations. What happened? No consensus. The year after that, the inclusive framework is established. So we know that now we have a larger participation of countries. Countries are seated on the table and they get the task to really find a global solution, find a consensus to address the challenge of the digitalized economy, and it's the so-called beginning of the BEPS 2.0. So from 2016 to 2021, the inclusive framework is discussing what are the options, what should we do, but on the meantime, countries are taking measures unilaterally. I'm not going to talk on all the details that happened during those years, but it's relevant to mention, for example, in 2018, the European Union issued 2 directive proposals to tackle the digital economy tax issues, one on significant economic presence and one on digital service taxes. We're going to see the details of that later in the webinar. And those proposals were paused because the EU decided that they were going to focus on the global solution, but some countries use that as a base to implement their own unilateral measures. So we have the beginning of the proliferation of unilateral measures with the DSTs, digital service taxes, in Spain, France, Italy, then we have also Turkey, Austria. They all started to implement the unilateral measures. We reached 2021 and there's the first milestone on the topic, that is the statement of October, 8 October 2021, where the inclusive framework members that signed the statement agreed on a 2-pillar solution. Why is this a milestone? Because in this agreement, they set up the characteristics of these 2 pillars, and for our purposes, pillar 1 is a relevant one, because through pillar 1, what they're trying to do is to relocate taxing rights to market jurisdictions by creating a new special nexus to be able to allocate a residual profit under amount A to the market jurisdiction without a physical presence. So it's this new solution that the inclusive framework came up with that solved the issues that Vanessa explained at the very beginning. We're not going to talk about the details of pillar 1, it's not the purpose of the webinar, but this statement has an impact on the unilateral measures because there are 2 commitments. The first commitment is that when pillar 1 is implemented, that is going to be done through a multilateral convention and MLC, all countries that had digital service taxes or similar measures would be obliged to withdraw their measures. So take back their digital unilateral measures on digital taxation and only implement pillar 1. So that's the first commitment. And the second commitment is that from the moment of the statement, so 8 October 2021 till 31st December 2023, so until the next month, countries will refrain to impose new unilateral measures. And, well, the text says new digital service taxes or other similar measures. At that point in time, nobody knew what was the definition. Nobody knew what was these other similar measures mentioned. in the statement. 2022 and 2023 happened. There are many public consultation documents. There's no agreement on the details on Pillar 1. It's quite technical, so the time frame of the inclusive framework is delayed. And we reached, as you can see on the right column of the slide, the last 2 milestones that happened this year. So we have in July, 11th July this year, there's an outcome statement of the 2-pillar solution that we're going to mention in the next slide. And in October, 11th October, so a month ago, the final text of the Multilateral Convention and the explanatory statement is issued. So Van, if you can pass the slide, please. Okay, so now we go to these 2 milestones, and we're going to talk about the next steps of Pillar 1 for the implementation, if it happens, and specifically on the impact on the unilateral measures. So on the outcome statement, what they refer regarding Pillar 1 is that the MLC at that point, this is July, is still being finalized, so the final text was not out then. And regarding unilateral measures, what the inclusive framework does, knowing that by 31st December, the first commitment of 2021 to not implement new measures was going to expire, they said, okay, let's extend this commitment of not to implement new measures until 31st December 2024, so 1 more year. However, that statement has a very important however, that it says that this commitment is to be extended if 2 conditions are met. And these 2 conditions are that at least 30 countries sign by 31st December 2023 the Multilateral Convention, and that 60% of the ultimate parent entities of the in-scope MNEs, of the in-scope multinational enterprises, are in those 30 countries. So just to give a bit of context, without going into the details of what is an in-scope MNE under Pillar 1 Amount A, around 100 multinationals are going to be in scope of Amount A Pillar 1. And the last number that I read is that around 48 of those 100 multinationals, the ultimate parent entities are in the US. So more or less, the whole point is that is the US going to sign or not the Multilateral Convention, because that would actually make or break if these 2 conditions are met. The statement of the outcome statement of July also mentions that if sufficient work is being done in 2024 to the implementation of the Multilateral Convention, countries can decide to continue and extend this commitment and not implement new unilateral measures until the end of 2025, so 1 more year. And in July, what they say is that the signature of the MLC was going to be open in the second half of the year, and that there was going to be a signing ceremony by year end. They have a month. Let's see if that happens, with the intention for the MLC to enter into force 1st January 2025. Well, we're waiting and see. Then we go to the second milestone, that is that in October, 11th October, they finally released the text of the MLC and the explanatory statement. It's a huge text, amounts over 900 pages, very detailed, very hard to digest. But for our purposes of today, I'm going to refer to Part 6 of the MLC. Part 6 defines what are detailed service taxes and other similar measures. For purposes of what I said, when the MLC that implements Pillar 1 Amount A enters into force, if it ever happens, countries that had a digital service tax would have to withdraw their measure. And we're going to talk about that later when we talk about these digital service taxes. But what is relevant is that under Annex A, they list specifically 9 digital service taxes and other measures taken by 8 countries that have to be removed, including the equalization levies in India, for example, and then DSTs in Spain, in Austria, and well, 7 other countries. I don't remember exactly which they are, but they're listed specific. And under Annex H of the MLC, they create this procedure for the convention of the parties, that are like the signatory parties of the MLC, that they will get together and decide when a tax qualifies as other similar measures. So long procedure, what we know is that already 9 measures are listed, and if this enters into force, this measure will have to be removed. Where are we right now? There's no date for the signing ceremony of the MLC. We know that for the MLC to enter into force, the two conditions have also to be met. So 30 countries amounting at least 60% of the ultimate parent entities of the in-scope MNEs. We also know that Treasury Secretary Yellen from the US referred a couple of weeks ago in a conference that she thinks that the issues with Pillar 1 will continue in 2024. So it doesn't seem that likely that the US will sign by year end. But for now, we just want to wait. We need to wait and see what happens, and have in mind that the implementation of Pillar 1, Amount A, would have an impact on the unilateral measures that we will discuss now. So I think that's it with this slide. Yeah.
Yes. So you've seen all the work on Pillar 1, that's 2.0. But despite the work and the proposal for a global solution, we still had many countries implementing unilateral measures. So this didn't prevent them from doing their own way. And you can see in the graph here just an illustration of how the countries have progressively implemented measures. And you can see, for example, there was a sharp increase from 2019 to 2020, and this was because back then there was the postponement of the global solution there was an uncertainty in respect of whether it would happen or not. So then we saw many countries going for unilateral measures. They didn't want to wait. We also expect now some increase from next year, because as Diana also explained, most likely the suspension will end by the end of December this year. So countries will be free to implement new unilateral measures. And we already see some movement. Many countries are already drafting legislation and making announcements that they will soon implement their own DSTs or other form of measures. For example, we just saw Canada confirming that they will implement their DST already from 2024, something that they always had as a plan, but was always waiting a bit for Pillar 1, but they simply decided no longer to wait, and they didn't even sign the latest outcome statement, and they already announced that they will implement that in 2024. We also have New Zealand that also proposed already a bill for a DST at the parliament, and that would be effective in 2025. We even have the Netherlands that always kind of supported and still support in a way Pillar 1, but already started to give some signs that it's not dismissing an implementation also of DST. So that's the trend, and it will probably continue to go up. And that's why we will need maybe to start thinking about how to coordinate all that. We wanted also to show to you a little bit of the trend in the design of the unilateral measures. So we gathered some unilateral measures, like most of them actually, because we do at IBFD, we monitor unilateral measures. We have a specific publication where Diana and I, we work with, and we monitor the unilateral measures of many states. So we kind of grouped and tried to find the main aspects in designing the taxes and how they are, how countries are, what is the trend for designing the taxes. And we see that basically for taxes itself, countries may have just create a separate new tax, like a digital service tax or equalization levy, or we have taxes on online advertising, YouTube tax in France. So you may create specific taxes separate only for that, or you can go for the regular income tax and you create a new taxable event for income tax or withholding tax. And maybe later we can talk a little bit about that, because there is also the impact in respect of treaties. There are also countries that go in a complete different directions. That's not that common, but you have, for example, in Portugal, you have specific fees levied on streaming services. In Brazil, of course, we don't have measures, but we have proposals that are still waiting there, and they are all most of them on as special contributions like CD or COFINS digital, or social contributions even on digital services. For the taxable event, you may have a broad approach, just basically indicating digital services in general, or you can specifically indicate the list of services you want to cover with the measure. The base will have, of course, gross versus net. Most of the measures so far have been aiming at taxation at gross, turnover tax, but most rates are low. So I put there most rates below 10, but actually in reality, they are really between 2 and 6%, 2-5%. That's normally what they have been charging. Everything normally above 10 would be because they are taxing on net income. And finally, for the collection, you have different methods. You have the registration that happens normally for DSTs, for example, the non-resident needs to register, assess and pay the taxes, file the returns and pay. But there is always the issue of compliance also. How do you make them, as we discussed also on VAT, how do you make them register? So some countries also try to either use the withholding tax as a way to try to make it easier, although with that you may lose B2C transactions that you could not. I think in Brazil even we have withholding taxes on technical services for B2B, but B2C, how can you collect that? For example, if you have an individual receiving streaming services, for example. So, but you still have some countries that manage to involve, again, banks, credit card administrators. So just like in VAT, and you have that, for example, Pakistan does that for the DST. They involve financial institutions to make that collection. You have also that in Turkey, even though Turkey, they implemented a DST, but it's not yet applicable. They need still some regulations, but they request the registration. But if you don't register, then the banks, the financial institution, they are under the obligation of making that collection. You have that also in Argentina with the tax, and Diana will probably talk about it, but we have the tax also of the city of Buenos Aires, where you also involve the financial intermediaries for the collection of taxes. And you also have reporting obligations sometimes imposed on some platforms to be able to collect taxes from the real service provider. So, for example, when you are in the sharing platform business models as C2C, as in Airbnb and Uber, where you have two private persons and the platform, and imagine that private individual that is renting the house or providing transportation services, they are normally subject to income tax on that income. But what normally tax administrations can do is that they can use and request from the platform information so that they can assess and be sure to collect the taxes from the person that is providing the services. And you have that in Finland, for example. You have platforms having to provide information in respect to short-term rental services like Airbnb and also Uber. You have that, I think, also in Costa Rica, the same, I think, for Airbnb. And there is interesting because even the information is not given directly to the tax authorities, but to a tourist agency that later passes on the information under an exchange of information cooperation agreement with the tax authorities.
So I will continue with the trends, but now we're going to zoom in into a region. It's the same map, so this map covers measures from proposed to fully implemented. So that's why the majority of the region is in blue, because the majority of the region has taken some steps, at least by proposing a measure. And I picked some examples here to show the trends that Vanessa was mentioning. Let's start with the one in Argentina. As she said, this is a local tax. It's a tax on gross revenue in the city of Buenos Aires. is effective since 2021 and it taxes the provision of digital services by non-residents in the city of Buenos Aires through the internet when it produces an economic effect in the city of Buenos Aires, when there's a connection with individuals, entities, or assets located in the city, or when the non-resident has an economic presence in the city of Buenos Aires. And for this, the law provides like a list of when it is considered to have an economic presence, and it has like all the type of digital services that we can think. So subscription to audiovisual entertainment, intermediation platforms, etc. What is interesting is that this tax, well, the rate is 2% on gross, it's a tax on gross, and the payment is collected through the financial entities and as intermediaries. So the law already establishes that the intermediaries are the ones that have to collect the tax. How do they do that? They do it based on a list that the tax administration issues. So the tax administration of the city of Buenos Aires regularly issues a list of the non-residents that are meeting one of the 3 criteria that I just mentioned. So they have to keep monitoring this, update the list, and then the intermediaries, that are the financial institutions, they know in which payments made by a consumer they have to withhold the tax. So that's one of the examples of the region. We have the case of Colombia. The case of Colombia is quite interesting because it's the only country in the region that has implemented a significant economic presence or a digital DE as such. It was implemented in 2022 by the reform of December, but it enters into force 1st January next year, so 1st January 2024. I'm not going to go into details because on the next slide, we're going to focus on this measure. But just to mention there, that is the only one in the region, so it's quite interesting and relevant. Then we have, for example, other countries. I have Peru and Paraguay as examples of countries that have included the provision of digital services in the list of taxable events that are subject to a withholding tax on income tax on non-resident. So they do that under the income tax law. And finally, on the bottom of the slides, I have 2 types of measures that are not income taxes, of course, but following the trends that Vanessa mentioned before, the global trends. The reporting of digital platforms. Vanessa already explained the case of Costa Rica. We also have the case of Mexico. Costa Rica, as she said, is only on Airbnbs and is go to the tourism agency. But in the case of Mexico, it's a general obligation for all the platforms that intermediate on digital services. They have to report on a monthly basis to the tax administration directly on all the customers and all the transactions where they have been intermediate. So this is happening in Mexico. And on the right side of the slide, I have on the bottom VAT on digital services. Again, the idea of the webinar was not to focus on VAT, but on direct taxation. But we want to mention this because it's a big trend in the region. So the majority of the countries of the region have implemented VAT. So they decided that digital services provided by non-residents are subject to tax with VAT. And the particularity is that the region was one, they took the option of using intermediaries such as banks, financial institutions, and also issuers of credit and debit cards as withholding agents of VAT. So I'm gonna just share 2 examples. We have Costa Rica. Again, they included VAT as a tax in Costa Rica when the service is consumed in the territory. So they have a list to determine when the service is consumed in Costa Rican territory. And how it works is that the non-resident can register directly. The non-resident that is providing the digital services can register directly with the tax administration and pay the VAT. If they don't do it, then the credit and debit card issuers are considered the responsible for withholding the VAT. And how do they do this? Again, with a list issued by the tax administration, and it's updated quite regularly. I think that every quarter they update the list. So they list all the non-resident service providers of digital services that every time that a credit and debit card issuers has a payment to those companies, they withhold. Of course, you think the big ones like is easy, Netflix, Spotify, like that's not an issue. The issue is how the tax administration can monitor like not that big names that are providing digital services. So maybe something can escape through there, but it's the way that they manage to make this collectible. Because as Vanessa said, the issue is with B2C transactions. Then the case of Colombia, again, I'm going to mention very quickly on VAT, how it works. The same subject to VAT, digital services provided by non-residents, and how it works. When it's a B2B transaction, the reverse charge mechanism applies, so nothing new there. But when the payer of the service or the recipient of the service is not obliged to withhold VAT, because it's not a business, it's maybe a final consumer, then the non-resident should register as well, but they can voluntarily apply to be subject to a withholding by the intermediary. So the non-resident can say, look, I'm not going to register there. That is a mess. Let's just apply for this withholding. And then the intermediary, that is the debit or credit card issuer or the financial institution, has to withhold the tax and make the payment. So, Van, if you can pass the slide, please. Now what we want to do, me and Vanessa picked 4 of the main unilateral measures that have been implemented by countries. So as I mentioned before, some have been implemented in the region, some haven't, but we want to see them because maybe they're an option or not. And we're gonna present a bit what are the characteristics, some examples, and we can discuss the challenges as well for each measure. So I'm gonna start with the significant economic presence. The significant economic presence, or the digital PE, what it tries to create is specifically a new nexus in the country or the market jurisdiction for a taxable presence, even without a fiscal presence. So that will solve all the issues that we were talking at the very beginning. And when this significant economic presence is designed, countries are using different factors. So it could be factor on gross revenue. So above a threshold, then you have a connection with the country. So this new nexus applies. It could also be digital factors, for example, that the website, the domain is in the country. It could be that the website, the language is the language of the country, or that the payment can be done in the local currency. All of these factors are also used. Also user-based factors, like, for example, the monthly active users, the number of digital contracts that are concluded, or the data that is collected if it's from users in that country. Then these are the factors that countries can choose when designing this option to create this new nexus, this significant economic presence nexus. And we're going to see in the examples what has been done in some countries. But the aim of this, as you can see, is to reach tax neutrality. We're linking to the first slide with Vanessa explaining the issue. Tax neutrality in the sense that digital businesses will now have a presence that if the business was physical, they would have as well. So you're taxing digital businesses in the same way as our brick and mortar business with the current, the traditional PE rules. However, there are significant challenges. We have treaty obligations, of course. We all know that under the current definition of PE in the treaties in Article 5, this is not included. So even if in the domestic law, a significant economic presence or digital PE is included, then if a treaty applies, it will restrict the definition of PE, so we won't be able to tax under the treaty. It's not clear, as I said there, in the main design, what happens when you have a business that operates both digitally and with physical presence, which is the nexus that you have to comply with to generate the PE. Are you going to have multiple PEs? How does it work? That's not clear. And the profit attribution, Vanessa mentioned it at the very beginning, but for me, it's one of the main issues of this, because just to explain quickly, currently under the AOA, the authorized OECD approach, we all know that you should treat a PE with a separate entity approach, and then with the functional analysis, you check significant people functions, assets used, and risks assumed. And in this case, specifically, of course, there's no people. This is all digital. You don't have presence. You don't have assets. So if you apply the current AOA rules, very little to nothing can be attributed to a digital PE, because there's nothing happening in that country apart from something digital that is not covered under the traditional rules for profit allocation. So what has happened and what have countries done that have implemented this? I'm going to briefly mention the EU directive proposal. As I said, this is from 2018, and it was paused because they wanted to focus on the global solution. But the EU directive proposal how it was designed, they use the three factors, so they use a mix. So they had gross revenues on digital services above 7 million euros, also more than 100,000 users in a member state, or more than 3,000 digital contracts from a member state. So if any of those factors was met, then the non-resident was deemed to have a significant economic presence in a member state. The digital services that they cover were profits from data of the users, so like advertisement, also like services connecting users, so marketplaces or digital platforms, and streaming services and other digital services. What is interesting from this EU proposal, well, apart from the fact that they're proposing a digital P, is that they included a full article on how to attribute profits to this new significant economic presence. So what they did is that they mixed or adjusted a bit the current AOA process. So they say, yes, you need to see the significant economic presence with a separate entity approach. You need to still do the functional analysis. But when you do the functional analysis, you need to include economically significant activities performed through the internet or this digital interface into account. And they listed which were these economic significant digital activities. And then they suggested the profit split method as the most appropriate method, the most appropriate transfer pricing method to attribute profits to the PE. But that was the proposal, nothing happened then. In Colombia, as I said, the new significant economic presence, just to briefly explain, they use also the three connecting factors, a combination of them. For commercialization of goods, they only use the threshold of gross profits, I think is above 30,000 tax value units in Colombia is a threshold, or 31,000 tax value units, and 300,000 Colombian clients or users. In the case of services, they have these two factors plus a list of services that are covered. The list is quite broad. It even has like a catch-all thing in the end that says any other digital service is included. Includes online advertisement, streaming of digital content, intermediation platforms, like all the typical digital services. How did they solve the issue of attribution of profits to this significant economic presence? They went for a very simple solution and they said, we're not going to attribute profits to this. What we're going to do is we're going to apply a 10% withholding tax on the gross pay. As simple as that. The non-resident can elect to also pay a 3% on gross if they register in Colombia and they present the income tax return. So it's kind of a mix, because when you see the design of having a list of services targeting the non-residents with a 3% tax on gross income could be similar to a digital service tax, but they included it in the income tax law and it's through an income tax return. So in this case, it will be part of the significant economic presence under income tax. We also have there, well, Israel has very specific characteristics for the factors. So they ask that the website is in Hebrew, that the payments are in the local currency for the significant economic presence to apply. Italy, just to finish with this.
Yeah, I was going to just say maybe quick, because I think we are quite late.
Yeah, sorry. Well, Italy, in the end, they included the concept, but they didn't change the attribution of profits to P rule. So in Italy, it's actually not an effective measure in practice because there's nothing to attribute to this digital PE. So there's still an ongoing debate in Italy, and they haven't found the proper way to treat this significant economic presence, probably because they're also waiting on the global solution. But yeah. And sorry that I took more time than.
No, it's okay. I think we still have some like 3 measures before we start really talking about it. So I'm going to really just go through the main aspects of the measures so that we can have some time for discussions. When we're talking about withholding taxes, it's of course one big unilateral measure that is being used by many countries. Countries can have different approaches. They can simply tax let's say they list the services that they want to submit to withholding taxes. And normally they do that already focusing on digital transactions. Or you have cases also where countries just apply withholding tax on technical services. And because of the definition of technical services in their domestic law, they manage to also catch some digital services because it's a very broad definition. They can, and this has an impact on treaties that I'm going to mention just in a minute. Of course, the withholding tax it's normally on gross at low rates, final withholding tax on gross, but you can also have that as being a prepayment of a tax that is going to be assessed and paid later on a net basis. Normally works well, withholding taxes for B2B transactions. For B2C, always a challenge, as we said, for the collection purposes. How do you make the private consumer withhold a tax? And that's why many countries, as I said, Pakistan, also Argentina, Turkey, they have been using intermediaries like financial intermediaries and banks, credit card administrators to do that, although the OECD does not recommend. When we are under treaties, there is a problem here because treaties normally would block the withholding tax because Article 7 only allows you to tax if you have a PE there. What countries they do is if they have, if they're trying to tax that under technical services, they can either expand the definition of royalties to cover also technical service and therefore allow source taxation, or you can of course use Article 12A of the UN model that allows also source taxation for technical service fees. You may have just an interpretation issue there because the UN model, in the case of the 12A article, understands that you should not use the domestic law to define technical services because you have an ordinary definition, ordinary meaning, contextual definition of the term. That would be basically when you use specified knowledge, expertise, and that it would not involve services of a routine nature. And because they defend that there is this contextual or ordinary meaning that is not dependent on domestic law, you cannot fit their digital services. While countries come with a different argumentation and they say there is no definition in the treaty, Article 3, paragraph 2 allows me to use my domestic law, and I understand, according to my domestic law, that technical services could be also applicable for digital services. So you have that, that conflict of interpretation there. You also have the option of just including Article 12B on automated digital services that was created by the UN exactly because they say these services are not under 12A. We have a specific article for that is the 12B that you could also use. There is an interesting policy suggestion by Andrés Baez, who is a professor in the University of Madrid. And he basically says, if you are always using 12A in your treaties to try to catch these services, he doesn't recommend you to start using 12B because it will just harm your interpretation line of thought or the reasoning, because it will just confirm your approach, the approach of the UN saying 12A does not include automated digital service. That's why I'm now asking for 12B. So they say, he says you should refrain from trying to include 12B and continue with 12A and the interpretation that you can tax it because your definition on the domestic law covers also digital services. I go now to digital service tax, Diana.
Yeah, so, well, digital service taxes, as we mentioned in the very beginning, are the unilateral measures that have been taken by the majority of the countries. So what are digital service taxes? And here I'm going to refer back to what I mentioned, that part 6 of the MLC to implement Pillar 1 has a kind of definition, or at least a criteria that they're going to check to determine if there's a digital service tax in order for countries to withdraw if Pillar 1 applies. And it says any tax imposed by a country, however is drafted, that complies with the 3 cumulative criteria. So these 3 criteria have to be met. It's imposed on market-based criteria. So in the location or customers or users, that's the market-based criteria. It applies the factor or the jure to non-residents or foreign-owned businesses. So it's ring-fenced to non-residents. And the country that implemented the tax treats it outside the scope of tax treaties. We're going to see that the tax treaty application is one of the challenges. So in general, the DSTs are an additional tax on multinational non-residents providing digital services, always on gross or on turnover. So there's a threshold for this to apply. In the case of the proposal of the EU, that was the basis for many EU countries to design their own DSTs. The tax rate proposed was 3% on turnover, and the threshold was companies with more than 750 million euros, out of which 50 million euros were taxable in a European state for these digital services. The digital services were sale of advertisement space, so online advertisement, intermediary services, and sale of data collected from the users. As I mentioned, more than 20 countries have implemented DSTs, not just in Europe, but all over the world. And as Vanessa said at the beginning, there are proposals that are on pause, but they're going to be effective as from next year. Canada, also New Zealand in 2025. But the design is different. There's no coordination. So even if we have this sort of proposal from the EU, each country took what they wanted. So for example, we have Austria only taxes revenues from online advertisement. We have France that taxes revenues from services, including a provision of digital interface, targeted advertising, the transmission of data collected. Even the rates are not consistent. We have rates that range from 1.5% in the case of Poland to 7.5% on gross in the case of Hungary and Turkey, for example. There's a proposal from ATAF. ATAF is the African Tax Administration Forum from 2020. Well, a proposal. They suggested an approach on how African countries can draft their DSTs. They have some specifics that are nice to mention. For example, one of the challenges, the ability to pay principal, what happened to companies or businesses that are loss-making businesses. ATAF solved this saying, well, this won't apply to loss-making businesses. There are thresholds. The minimum thresholds for the application is high. So small and medium enterprises and or startups won't be covered by this. So you're not harming the growth of the digitalization in Africa. That for them is quite important. So you're only targeting the large multinational. And the rate that they propose is low, between 1% and 3%. The main issue that we have here is, and this is very relevant to consider, that is one of the 3 criteria from the MLC of Pillar 1, are these taxes covered or not by treaties? So the discussion that has happened lately, and you probably have heard, is, are DSTs indirect taxes and thus not covered by a tax treaty? However, we have discussed this a lot in me and Vanessa in IBFD, and an indirect tax by nature is a tax that is meant or is designed to be transferred to a third person that is not the taxpayer. So the main example is VAT, and through the system of credit and debits is transfer, and the one that actually carries the burden of the tax is the final consumer, not the VAT taxpayer. But that's the design and the nature of the tax. And of course, there's an argument that businesses can include the cost of the DST into the price, and then the price will be higher and the consumer will have to pay it. But that can also happen for income tax or for whatever municipal tax that happens. The businesses can increase anything as cost, and then the price is higher. But the design, the nature of the tax is not to be transferable. So actually the discussion is our tax rate is going to apply. Is this a tax on gross and revenue, or is this a tax on income? Then is where you can say, are we talking about something that is covered or not by tax treaty? The discussion is still ongoing. We all know that the countries that implemented DSTs, they believe that these are not covered by treaties, but it's very important to have this in mind because it's not a clear-cut discussion. And the design of the DSTs was mixed. You can see from the discussion that they took many things just to get them out of the application of tax treaties, because if the treaty applies, then market countries cannot charge DSTs. But now is one of the criteria that the MLC included for the DSTs to be, for countries to be obliged to remove their DSTs. So with this, I think I finished and we can continue with the last one.
Sorry, I forgot to unmute. This is the last one, the equalization levy, a tax that was introduced in India in 2016 with a reduced scope back then. Later, it expanded. It is an important tax because it was also recognized by the OECD in its reports. And initially, it was designed to tax online advertisement. So there was a restrictive scope levied at 6%, also on gross, through a withholding by the payer, but it was excluding B2C. So also because normally you wouldn't have online advertisement to a private consumer. So in 2020, they expanded it to also apply for other services, sale of goods and provision of service by e-commerce operator with a lower rate, 2%. And in this case, you would have the registration of the non-resident, also because you are here covering B2C, which is always an issue when you have withholding tax. So what is interesting about the equalization levy is that the equalization levy and income tax, they are mutually exclusive in the end. So if the income is subject to equalization levy, it would be exempt then for corporate income tax. Or if the income is effectively connected to a PE in India, which would mean that it would probably be subject to income tax, then you would not apply the equalization levy. And that's interesting because what India did when it implemented equalization levy, it argued this is a separate tax. This is not income tax. We are introducing it outside the Income Tax Act. And the reason behind would be that they wanted it to fall outside the scope of treaties, like Diana was mentioning, all this issue of are you within or not the scope of treaties. Although formally it looks as if it's a separate tax, when you go to the details, and especially because of the reasons why it was introduced exactly because the non-resident was not paying taxes under income tax as a PE. It was also mutually exclusive, so it's basically one replacing the other. When you have equalization levy, you don't have income tax and vice versa. So all these elements was showing that if you analyze materially, it would be very similar to an income tax. And the fact that it's just taxed on gross wouldn't be per se only the reason for you not to consider as an income tax. Of course, this is debatable, but if you have a very low rate, you could be reflecting actually that non-deduction into the rate, and effectively you would have an equivalent to a net income tax. That's how it works also for withholding taxes in general. They are still income taxes, even though they're taxed on gross. So that's an interesting side of the equalization levy. I think we can just finalize very quickly, just pointing the pros and cons here before we debate, Diana.
Yeah, well, 1 second, the pros, we know that countries can adapt their measures to their needs, tailor policies, of course, flexibility, as we saw, speed, we don't have to wait for a global consensus that have taken years, and they're simple to administer. That could be seen as a pros because the country can find the mechanism that better suits them. So I think that just quickly mentioning that, but we already discussed in each measure.
Yeah, I think also the cons we have sometimes already mentioned throughout the webinar. The cons would be securing compliance by MNEs when you are dependent on, for example, registration. That's the case for DSTs. You need the non-resident to register and pay the tax. Also, of course, many of these measures are based on gross, which may impact companies in a loss position. And Diana already mentioned that. Of course, especially for small companies and startups, that could be damaging because they would not have the capital or reserves to deal with that if they're in a loss position. it can lead to, of course, the trade disputes, the tariff retaliation from the US that we've seen, lack of harmonization. You have different taxable events and taxable and nexus, so that you probably have double taxation because, for example, you would have one country deciding that they can tax because the IP is that country, the other one because the payer is here. So you would have double taxation, and that's why we would need some coordination in respect of these taxes. And of course, you would have compliance, different type of compliance in multiple jurisdictions. I think now we can maybe go for some points that we thought could be interesting to discuss.
Yes.
I don't know, Anna, if you wanted to ask something first.
Yeah, no, I just wanted to mention first that what a fabulous lecture. It was you were able, it was an amazing lecture. You were able to cover a lot in a very short time, actually. It's like in 1 hour and something. It was a lot to cover. Thank you so much. It was a great lecture. And I forgot to mention earlier that Vanessa and Diana, they are members, they work with IBFD, which is one of the most important tax institutes in the world. So it's what an honor, a great honor also to have IBFD with us. Thank you so very much. And I also forgot to mention that this event was organized and was idealized within our women branch, which is WIM, Women of IFA Network. So it's a great joy to have here these two amazing women teaching so much to us. And at WIM Brazil, Vanessa and Diana, I don't know if we mentioned it to you, but we also, we like the boys to be with us as well. So that's why Felipe is here, because even at WIM events, it's a joy to have the boys with us as well. And we have so much to unpack, like from what all that you have been teaching us for the last hours. I was taking notes here, and there are so many interesting. I think that maybe we could take out the PowerPoint, maybe, and then, oh, thank you so much. And then we have so many things to discuss, interesting things. The source taxation in Brazil, which is very peculiar, very effective on B2B transactions, maybe not so effective on B2C transactions. We also have a new VAT legislation coming up in Brazil in the next few years. And this new legislation, if we do have the time, is also taking into account what you have been talking about the liability that was imposed on financial institutions, institutions of payments, and digital platforms to collect it. So it's so interesting to hear from you how other countries have done it, and we must learn from it. The treaty issue, I think that it is a very interesting issue for us to discuss. But before we get in these specific subjects, I was thinking, to make a very broad question for you two, a very broad one and a very difficult one to answer. How feasible do you think that it will be for us to have a global solution, a global approach? How feasible is Pillar 1? Because I should confess that from Brazil, we are looking like we are following up the news on Pillar 1 from far away. And sometimes I do ask myself, and Felipe and I, we were talking about it recently. Sometimes we ask ourselves if Pillar 1 is politically feasible. So I would love to hear from you. What do you think? A global solution will be at some point in time reachable?
Vanessa,
Maybe I can. I think it depends on the solution. The one we have there, as pillar one as it's there, if I have to bet, I would say no, not at least on a short, medium term. We know already that the US is not really, we have the problem of you need the US to join to make it feasible, and the US so far is not really going for that. So without the US as it is, pillar one cannot happen. So that is already a big obstacle. I think another obstacle is the reaction of some developing countries on the proposal of pillar one, because it considers that it's very complex and difficult to administer from the perspective of low-income countries that don't have a big capacity at the tax administration. So there has been a lot of complaining, actually, from developing countries, also in respect of how pillar one was designed. And I don't know if you've heard, but there is this movement now towards the UN with many, especially African countries, that they started this movement because they were not satisfied with the solutions proposed. And basically the solution proposed in case of pillar one for sure, pillar two also a bit, because there was impact on incentives. So they were simply considering these decisions were made formally. We were there because we're inclusive framework, or some of them are, but we were not really making any decisions because these decisions were already made and we were just invited. So there was a lot of criticism on also how pillar one was designed that did not really take into account the situation of developing countries, even though it's meant to give them taxing rights. But the way it was done was less, let's say, as they expected. There are some studies that may also say, well, we would collect more if we would keep our unilateral measures, for example. And it's very difficult to administer because it's very complex, the rules. So I think there are different sides that go against pillar one, and that makes it even more difficult. And we are waiting now for the UN because there seems to be this movement of the UN. There was the resolution of the UN saying we want to now also be in charge of driving the tax policy of the global tax policy. And they already kind of gave us some signals that pillar one would not be the alternative that they would go for. So to be honest, I as I said in the beginning, I see the time passes, I see it less likely that pillar one is going to happen. But of course, we never know. Maybe tomorrow something happens and everything changes surprisingly. We don't know. There is also a hidden problem of pillar one in the MLC, the Multilateral Convention for Implementation, is that, and this was something that was said by Stefan Weigel at IFA Congress now in Cancun. He said, we have a problem there because for making the Multilateral Convention to be effective, we need the US. And for the US to sign, they need the Congress. But imagine that this happens and it happens and they sign. But later on, to terminate the MLC, the US does not need the Congress. And he was kind of alerting, maybe you have in the future a president in the United States that decides one day I don't like this anymore, and they terminate the MLC, which will terminate for everybody involved because the US needs to be there for the MLC to be effective. So imagine that everybody gets rid of the unilateral measures, implement pillar one, and from one day to the other, a president of the United States decide, I don't want this anymore, I don't like it, tomorrow we terminate it. And then the whole world will have to rethink everything again. So there are many issues concerning pillar one. So I think if I would have to bet, I would say no.
Just to add one thing of what Vanessa explained, I fully agree with her. I also bet no, or at least not in the short, medium term. But she mentioned some reports on the cost benefit of implemented Pillar 1 versus unilateral measures that is very, very long for developing countries. And this particularly, there's a report from the South Center and the BEPS monitoring group, which is super interesting. They calculated in 2020. So it's not based on the latest MLC rules of Pillar 1, but they calculated that out of 84 African and South Center countries, the tax collected on the amount A was around $5,000 million. And if they would apply Article 12B of the UN, it was more than double. It was $12,000 million. And it is relevant because when each country has to decide, and it becomes political, as you say, Ana Carolina, because in this report, there's a mention to something that for me was mind-blowing. It's the case of Sri Lanka. Sri Lanka was analyzing if they wanted to implement a digital service tax in the country, and they had the proposal was like 3 or 4% rate, as I explained, nothing too crazy. It was more or less the same as other countries were implementing, and they made the cost benefit analysis, and they were expected to raise, I think, over $100 million for a small country in Sri Lanka. That they calculated that with amount A of Pillar 1, they would only get like $30 million. So it was more than double than what they were going to get under amount A. Sri Lanka didn't sign the outcome statement, didn't sign the statement of the inclusive framework, so they had no commitment not to implement new measures. And what was reported by the South Center is that apparently there was some pressure from the IMF to the Ministry of Finance of Sri Lanka not to implement a unilateral measure on an uncoordinated matter, but to wait for the global consensus. And the South Center, that is a very well-respected institution, they said, we're going to support developing countries to do this cost-benefit analysis, because it's not only not implementing unilateral measures that target the in-scope MNEs, because the compromise is to not implement digital service taxes and other similar measures to all companies. So even if just 100 MNEs, so for now, are going to be in scope of amount A, countries are committed, if they agree on Pillar 1, and if Pillar 1 happens, not to implement unilateral measures that also target other digital companies that might not meet the threshold of the 20 billion euros of turnover. So if it happens or not, well, I bet no. Let's see what happens. But also for developing countries, it's a moment where it must be analyzed, like not just coming under the political pressure, but is this really beneficial for us? And so, yeah, just to add this.
Vanessa and Diana, thank you so much. I'm learning a lot, and I think all of us are learning a lot. And Anna, more than a pleasure, it's a duty to support. I think so. And it's a duty to support an equal space and opportunities. I'm a father of 2 girls, and I really hope them find a world that guarantees them the opportunities they deserve, right? So I think more than a pleasure, it's a duty. And I have to say that here. And I said this yesterday in a beautiful event organized by Mulheres no Tributário, Carol and Fran. And if I have the opportunity, I always say that, because the world needs to hear this, listen this, right? So back to our topics. I have some thoughts and questions, of course. And I don't know, Brazil tried to implement a unilateral measure some years ago. In fact, it started processing a bill, and the US threatened to retaliate by increasing tariffs in Brazil goods. So, of course, Brazil gave a step back, and I don't know, Anna, but I think we are not discussing a DST anymore. We are discussing only the tax reform, and tax reform is not reaching digital service, maybe the platforms, only the platforms, I think so. So the funny thing is Brazil tax at source, right? And it does not affect B2C transactions. And we are talking about more than 140 million people connected and buying using internet, using smartphones. And again, the curious thing is, if Brazil tax at source, and Brazil in the past and still tax created a seed contribution that does not comply with the treaties. But on the other hand, Brazil was not afraid of possible retaliation. Maybe Germany, because we don't have a treaty with Germany anymore. And one of the reasons was the contribution, and US threatens countries with retaliation if they tax American multinationals. We saw this especially in Europe, and Apple case and Starbucks case and other cases. And is this an effect that prevents for global taxation or a fair trade balance? I don't know, like the countries have the right to tax, or I know it's an utopian, like a consensus. And when I went to IBFD, Joan said to me, like, Felipe, it's a utopian. Because I was defending, at that time, I was defending the consensus. And I don't know what you think about it. Just to complement, maybe, I have a sincere doubt about the context of the interaction between Pillar 1 and 2 and the DSTs. Of course, there is an interaction, but I have some doubts because exactly the balance, talking about the balance, how countries can find the balance between their national interests and the broader objectives of international tax reform. Again, consensus always seems to me the best path. Recognizing that borders and customs barriers are no longer sufficient to control the wealth and even the people who access national markets. Not only the wealth, but the goods and people, because at IFA Congress, we were talking about remote access, remote workers, remote directors or directives. So I don't know. So maybe I have two questions here about this balance and the rights of the countries to tax. And maybe, but I think Anna already did this, about the consensus, if it's possible or it's a dream. What do you think about it?
If you do allow me to complement Felipe's point, which is very good, I was wondering whether we would have to reach such a stage of trade war so bad that then it would get bad enough for all the countries to get together and make it better. I was wondering whether this would be a way, like it would make the global solution like feasible, like a very bad trade war, trade environment. And besides that, we have the honor of having Marco Sintra, Professor Marco Sintra. He's the vice chair of FGV, Fundação Getúlio Vargas. He's watching us and he's putting comments, offering comments to our webinar at our YouTube channel. And something that Professor Marco Sintra has frequently raised is that he's Professor, please forgive me if I am putting words in your mouth, but I will try to put his thoughts like this. He's asking whether it's worthwhile to have all this complexity to raise the funds. And his comments, I think that they have a connection with what Diana was mentioned minutes ago. It's like, is it worthwhile to make the tax system so complex to raise the funds that we are intending to raise? And wouldn't it be time to maybe look for some sort of different alternative?
Yeah, exactly. Yeah, I agree. And that's the whole discussion on Pillar 1. Pillar 1 is too complex. They don't think it worth. That's what developing countries have been saying. They don't like the solution because of the complexity to administer that. They don't have the capacity in their tax administration. So, of course, that's why many of them prefer other solutions that are simple to administer, so like withholding taxes or even the DSTs in a way. So yeah, I agree. I think Pillar 1 became too complex to worth, especially because and there is also some argumentation saying that in the end maybe there is not so much tax levied even with that. And although some countries say, but we need to do that even as a response to the public because they know that these companies are not paying taxes. So I am completely in for alternative measures. I'm not at all on the side of Pillar 1. I would be completely in for a withholding tax, for example. So I agree for that question. For the balance that Felipe said, it's very difficult to make an analysis when it's not only about tax, that you have other elements involved that we sometimes don't even know when countries are negotiating. There may be other issues between two countries, and they may also take that into account. But if you look only at tax, in my perspective, the argumentation of the US is not, it's very superficial because you are not targeting US companies. Of course, in the end, they're the ones paying because they're the ones not paying the taxes in the first place. But they are not directed to them. And even when they come with the argumentation, yeah, but you are taxing non-residents and you are exempting the internal companies, either because you are putting them outside the scope of a DST or because you are putting thresholds in at a certain level that you catch only the American companies. This is half of the story. The other half of the story is that these companies in France, they are already paying taxes because they are already subject to corporate income tax when they make online sales internally. So it's not that they are implementing taxes because they are targeting US companies and they are trying to protect the French companies. The French companies never stop paying taxes. If you have a French company making an online sale from Paris to Montpellier in France, it will have to pay taxes because it has to declare. It's under the system, under the corporate income tax system. It doesn't depend on a PE. So there is no unbalance in the sense that you are targeting US companies, non-residents, and protecting your companies. The companies internally, they are already paying taxes. What you want is that the non-residents also pay. And in the end, of course, the US companies are going to be the ones that are going to be affected because they're the big tech ones that are not paying the taxes in the first place. So this argument, for me, is a rhetorical argumentation because it's really half of the story. But if you go to the core of tax, I am completely in for all the taxation of the non-residents that are not paying taxes. For me, that's the fair thing to do. Whether countries will manage to do that, because of course the US will come with this argumentation to retaliate with tariffs and trade war and so on. Yeah, then let's see how the balance will go. I feel that there is a lot of support coming nowadays since especially the UN resolution of many organizations and many institutes like the South Center. You have an institute also in the UK. Many institutes are providing research and material for developing countries to support their position. So I see a little bit of a shift going more in favor of developing countries, and they are getting united. In Africa, they are really getting the bloc very strong, and they're going to the UN as a bloc, and they're putting proposals as a bloc, something that the Latin Americans should be doing as well. They started doing, but I think in Africa, they're really strong. And that's also one of the recommendations of some institutes is that, you know, smaller countries should go into bloc and present their ideas as a bloc, so they are less intimidated also. So I feel that is a tough fight with the US because, of course, a trade war is always difficult for many countries, but I don't see it as a lost war. I really see a trend now, and if the UN joins in now, I really feel that it's going to be a tough fight.
I'm afraid Brazil doesn't have a position. I think this is the point, maybe.
Well, I just wanted to add something related to what you say, Felipe. ATAF is very big, indeed, the bloc of Africa, but in Latin America, we have this new tax cooperation platform that was created this year. It's called, I have it written here, Tax Cooperation Platform to Move Towards Sustainable, Equitable, and a Global Taxation, and I'm discussing this. And it's composed by ministries of finance. Brazil is part of it. So ATAF is tax administrations. Here you have the real policy makers are going to be there, and it might be a way for Latin America as a bloc to put forward their positions, because what I believe is there has to be a coordination, even if you don't go to Pillar 1, because Pillar 1 is extremely high to administer, difficult to administer, extremely complex, and it can only benefit developed countries in the end, as many countries, developing countries, have been recognizing lately in the sense of collecting, the amount of collection. But at least what it says that, well, you don't have double taxation, you have a coordinated system that if you manage to apply it, it would work. If you're going to go to unilateral measures, there has to be a way to coordinate the unilateral measures. So me and Vanessa were discussing one day, like maybe a multilateral instrument to modify treaties, and then you can apply DSTs under or digital PEs or whatever the measure is, but something that actually coordinates, because also for businesses in this tax cooperation platform in Latin America, the last meeting that was a couple of months ago, the ICC, the International Chamber of Commerce, all the branches in Latin America submitted their comments. And one of the comments was like, there are so many measures that, of course, for businesses, this is too much. We're double taxed. We have a lot of administrative issues that we have to file returns for different millions of different taxes everywhere. So there has to be a coordination for this to work. Although in my view, as Vanessa said, I agree with her 100%. Pillar 1 is too high to administer and too difficult to administer, and I don't think it's going to happen anytime soon. So just to add that.
And I don't know if we have time. We still have time. I only have one more question. I don't know. If are any of the unilateral measures, I don't know, included within the scope of a treaty, or in your opinion, and I think you said this, would they be considered indirect or indirect taxation, and therefore outside the scope of the agreements? Because what I understood is all of them are out of the scope of the agreements, but I don't know.
Well, it depends on the tax. Like, we cannot say all of them are outside. It really depends on the features of the tax, and actually also on how Article 2 is written. But the question is not, Diana explained it a little bit. The question is not whether it's not about being indirect taxes. They are taxes on turnover. The mere fact that it's a tax on turnover doesn't make you an indirect tax. Many people think that because of VAT. VAT is a tax on turnover and an indirect tax. So you kind of think it's the same thing, but it's not. An indirect tax, as VAT, for example, is as Diana also explained, is the one that is, you have, as we say in Brazil, contribuinte de fato e contribuinte de direito. You have the legal taxpayer, that is the business, and you have the real taxpayer that receives the bill at the end, because it's a consumption tax. This is in the nature of the VAT. It makes it an indirect tax. When we talk about DSTs, for example, this doesn't exist. The DST is a tax targeting and is charged and targets the business. It's not meant to be passed on as a system of the tax.
Gross.
Yes, they can do that, but it's a business decision of the company.
Yeah.
The mere fact that you decide to charge as a cost doesn't make it an indirect tax. You can decide whether or not you do, because then you see if my price is going to be higher or lower. It's a business decision. For VAT, you don't have this decision. The VAT you have to pass on because it's the system of the tax. So this is not really, I mean, I don't consider the DSTs and these equalization levy as indirect. They are not indirect taxes. They are taxes on turnover, on gross. Then it comes to the discussion that Diana said, is it because you are gross and not on net that you are outside the scope of the treaty? And that's a good debate, because it's really debatable. You have withholding taxes that are on gross, but they are covered by the treaty. So there is a lot of discussion going on there. And to be honest, for me, I would think that you could, based on interpretation elements, good faith, many public international law, you could say that the country was trying to dodge the treaty by giving the taxes some formal design. And because of that, you breached different principles in international law, good faith, even the treaty itself. So you have many arguments to say that it's not. First, because it's similar, and second, because the country tried to dodge the treaty. So that's one thing. Of course, countries will always try to argue that this is not an income tax. They don't want to be, because they will be blocked by the treaty. But that's an interpretation discussion. The fair thing would be, the best one would be to say, everybody, hey, let's say I don't know, apply DSTs now, everybody, as Diana said, we coordinate, we put in the treaty, and we say, it's in the scope of the treaty, but we allow source taxation for the DST to be, that's the right thing to do.
Or even 12B, countries can say, okay, let's go for 12B, it's a withholding, it's super
it's a withholding in 12B.
Developing countries.
The only problem is that you have to renegotiate treaties or sign, and that comes the US is not going to sign. But do developing countries have so many treaties with the US? No. So you see how then the US will retaliate with tariffs. So there are many elements there to take into consideration.
Yeah, on this topic, I wanted to advertise the book of our dear friend. The book of our dear friend Leonardo Thomas, and he has a book.
Yes.
On o artigo da Convenção Modelo da OCDE e os Digital Services Taxes. Very good book. Great book on this subject. And thank you so much. I don't know if we have time for additional questions, but this presentation, fantastic presentation, has been recorded and will be on our YouTube channel, IFA Brazil's YouTube channel. And I learned a lot with you, Jana and Vanessa, and thank you so much. And Felipe, it's always a pleasure, my dear friend, to be with you.
Always, thank you so much for your support, and Vanessa and Diana, I hope to see you soon. Thank you so much.
Thank
for
you
sharing
too.
so much knowledge with us.
And thank you for making it in English.
Oh,
yes. Also for me. I prefer.
It's not easy and natural, but for us, but of course, it's always possible, and especially nowadays, right? And English or Portuguese, okay, we are able, and we are here ready.
And we're going to see each other in Rio at IFA Rio, the IFA Latin America.
Yeah.
We're going to be there.
Please come.
We are
We are
coming
waiting
next
for you.
year. Yes.
Please, it will be fantastic. Fantastic.
Yeah,
So
fantastic.
thank you so very much. I think that I had so many notes taken, and I had a lot more to talk about, but we are reaching our second hour, and I think that we'll have to schedule something else, Felipe. We'll have to schedule other meetings with Vanessa and Diana to discuss the other subjects that we wanted to discuss today. But thank you so much.
Thank you so much.
Thank you for the invitation.
Thank you. Bye-bye. Take care.
Bye-bye.
Bye.
Bye.
Have a great day.
You too. Bye.